Why is New Zealand looked upon as a crash test dummy for the whole global economy? What differentiates the situation in New Zealand from the rest of the world? What does New Zealand's monetary policy tell us? And what is the current momentum of their economic housing prospects? In this video, we will deep dive into New Zealand's economy, discuss key data regarding its economic growth, central bank monetary policy, and its current dire housing conundrum. Hello friends and welcome to the Market Watcher, a place for gathering traditional financial and all other investment knowledge on a regular basis. Subscribe to our channel, like the video and hit the bell icon if you don't want to miss out on any of our truly informative and comprehensive video analysis lectures. As always, everything said is with educational purposes only and should not be considered to be financial advice. As stated in a recent article in the New Zealand Herald newspaper, the NZ housing market is seen as the world's crash test dummy. Economists around the world are keeping a close eye on what happens to the New Zealand housing market amid the aggressive tightening of the monetary policy. The Reserve Bank of New Zealand was the first one to start fighting off inflation with strong pushes of its main interest rate. If we take a look at the one-year chart of the interest rate levels, we see truly a very aggressive hike from 0.25% around the 1st of October of 2021 to 3% less than 1 year later. The change in the tightening of the monetary policy passes through to mortgage rates, which in turn passes through to falling house prices. As the cost of debt goes higher, fewer people will borrow money to buy a new home, and more people will sell their current existing house because their payments are starting to increase. Mortgage rates have gone from around 2.5% to 5.5% in quite a short space of time. The credit environment was a key driver of the upswing, and now it's become a driver of the downswing. We have less money available and it's costing more. Although aggressive hikes, we are still quite below what is considered to be high interest rate levels. If we take a look not at the singular year interest rate chart, but the 25-year chart of the interest rates, we will see the current level of 3% is below the periods of the late to early 2000s and below the 2007 and 2008 levels, which both were around the 8% mark. As seen on the next chart, at that time the mortgage rates were sitting at about 10%. On the same chart, we see the abnormally low rates seen in late 2020 and early 2021. And now the trend is reverting and the mortgage rates are climbing back to their average levels of about 6 to 7% over the last 2 decades. To visualize the correlation between the central bank rates and house price levels, let's look at a one-year chart of New Zealand's housing price index. The rate hikes started in October of 2021, while the peak of the housing market was seen in November of 2021. Since then, the index has fallen by roughly 13%. So up until now, the average home price drop is 13%. With more rate hikes to come, the housing market most likely will continue to drop. While looking painful when looked with a short-term view on things, if we expand our view to one which has a more of a longer time horizon, then home buyers and investors should not be worried. If we take a look at a 25-year chart of New Zealand's home prices, the prices are only going up. During 2020 and 2021, the average home value rose by 40%. So also looked from this perspective, a 13% drop now leaves us still well above the pre-pandemic levels. According to Nick Goodall, head of research at CoreLogic, one of the main analytical firms in the region, the capital could experience a 25 to 28% annual drop if the current rates stay the course. Although we were quite negative up until now about the future of the NZ housing market, we must acknowledge that the current decades-high inflation level is a definitive driver of a somewhat smoother landing of the housing market. As seen in an article by The Guardian, food price inflation is the highest in 13 years. Some products like tomatoes and butter had insane price hikes of approximately 162.2% and 103% respectively, while overall grocery food prices were up by 8.7%. Fish is up by 7.6% and the beverages are up by 4.1%. The general average inflation rate for all products and services is 7.3%, and this is the highest level for the last 32 years. Only in the 1990s the price rises were more severe, as seen on the provided chart via Trading Economics. If we use our economic historical basics, an inflation level of 5% has only been stopped with a main interest rate hike of more than 5%. With the current level sitting at 7.3%, the main interest rate of 3% has a long way to go up. This will shake up the New Zealand citizens quite hard, and it will squeeze their pockets severely. Up until now, the labor market is very strong. Just recently, the unemployment rate hit a record low of 3.2%, as seen on the 10-year chart provided, with the most recent data showcasing a 3.3% level, which is still very low, and the labor market is showing strength and resilience. While the unemployment level is only dropping downwards over the last 10 years, this phenomenon sooner or later will dry out and the unemployment level will start to climb up. If we take a look at a 35-year chart, we see that the labor market has its peaks and lows. Now we are at a low, but it would not be strange or abnormal to see unemployment jump by 2 or 3 times the current levels, so that it goes to 6 to 10% for some period. If this happens, it is very likely that in some point the purchasing power of the citizens will start to diminish, and with that the consumer spending levels would drop, hence the inflation will cool off. In order to gaze at the near future, we can take a look at the business and consumer confidence levels of the New Zealand citizens. The level of confidence is showcasing the likelihood of an increase or decrease in the spending in the near future. When we take a look at the consumer confidence chart going back to the 1980s, now we're sitting at a record low of about 78%. Never before has the New Zealanders felt so economically distressed and filled with so much lack of confidence. This means sooner or later it is possible for the citizens to drastically cut back on their spending habits, which will decrease the economic growth even more. After the lack of consumer spending comes the lack of business growth and confidence. When looking at the business confidence levels, we see the same story. Although not quite at a record low, we are hovering around the lowest levels up to date. The current level of -50 is telling us that very few times in history the NS businesses have had such tough times. To end on a good note, the New Zealand economy and country have very strong fundamentals. According to the world-renowned Global Corruption Index, New Zealand is the least corrupted country. This makes it one of the most efficient countries. The New Zealanders are also one of the happiest people on earth. According to the Global Happiness Index, they rank on spot number 8 out of 180 countries. And according to the Global Wealth Index, New Zealand ranks as one of the richest countries in the world. According to GDP per capita metrics, New Zealand ranks on spot number 32. All these facts are a major building block for a more prosperous society, which is the main goal of all countries worldwide. This was our video analysis of New Zealand. Thank you for watching until the end. Leave a comment about which other countries do you want us to make an analysis, or tell us what economic and investment topics we must cover here on the channel. Subscribe to us, like the video, and I'll see you in the next lecture. Goodbye for now, and I'll see you soon.